Hi, I'm Bill Wilt of Assured Research. Thanks so much for joining this quick hit video where we'll focus on one topic drawn from our June 2024 Assured briefing. The note we'll focus on here asks the question of what's left to propel the property casualty insurance pricing cycle. Um, eh, Again, happy to share this. If you find this interesting and our other work, whether at LinkedIn or on our YouTube site here, feel free to reach out. We'd be happy to start you on a trial to our work. Allow me to share the screen and we will jump right into it. These quick hit videos are really only meant to last for about 5 minutes, and I think we can hit that target. There, so hopefully you're seeing the screen, and the title here of this particular slide, when good news is or could be bad news. Sometimes I'm drawing there from the investment community, where sometimes good news might just be viewed as a temporary boost, for instance, to income or a company's ROE, but could lead to bad news in the future, meaning declines in pricing, for instance, that needs to be built into the stock price. So here, using that as a kind of a framework, the idea is that economic inflation that we're showing here on the left, economic inflation and its pressures on liability claims, which we have created a kind of a custom series here that's a combination of medical inflation drawn from the producer price index, not the CPI, medical inflation, wage inflation, and legal inflation. Those would be the main components driving liability claims, starting to moderate. It's not as volatile as it was at the outset of the pandemic. Started to moderate. The black lines are the 95% confidence interval. Again, those are coming down. The moving average line is the red that you see there on the left, and that's kind of sort of settling around 3.5%. Something that I'd submit a lot of insurance professionals would view as manageable, even if it is higher than it was before the pandemic. On the right-hand side, we show the operating returns on equity of a cohort. It's somewhere between 25 and 30 publicly traded companies, property casualty insurers and reinsurers. The numbers that you see there are the spreads above Treasury, kind of the relevant benchmark when you ask, hey, is a company, or in this case, an industry, meeting its cost of equity? The answer is yes, most years, if you think maybe that's in the call it the 6 to 8 range as a spread above treasuries. But notably, if you look at 2024 and 2025 with return expectations as they were in the middle of May, those are 11 and 12 points, just below the peaks that the industry experienced in 2006, 2007, which was a few years after the hard market of 9/11. Favorable reserve development was starting to come through the industry's income statement. Those were, I think, notably light cat years following bad cat years in 2004 and 5. We're nearly there. So if you have economic pressures on liability claims moderating, you have returns forecasted to be near century-long peaks. The question is, what else could sustain the pricing cycle? Well, try to answer that in the research note. Social inflation could. There's some signs. We think that social inflation is maybe moderating. It's still very much in place and positive. Will it worsen from here? Hard to know, but certainly it's not surprising anybody anymore. Reserve charges could sustain the pricing cycle, and those we will see. We think commercial auto liability and general liability reserves are deficient across the industry, so we'll see there. A story to be written. Mass torts. Probably we've expressed concern over mass torts, especially opioid litigation and PFAS liabilities in an assured report recently. There, I think bad news is just bad news. If those come through the income statements and reserves that insurers have to take charges, don't know that really has a positive spillover effect on the pricing cycle. Two other possibly pricing cycle factors that could support the extension of the pricing cycle. If you look on the left, premiums as a percentage of GDP, we've drawn bars there to show what it looks like from 1970 forward. You see the cyclicality of the industry, and the observation would be that in 2023 we were kind of at the kind of decades long average of about 320 basis points premiums as a percentage of GDP. So clearly higher than it was a few years prior. Not There's no structural reason I don't think that the pricing cycle can't continue. So that's one mitigating factor. The other, on the right hand side, if you look at the earnings margin on the middle box, or the one on the left of the two, and then on the far right, sales growth. The point is that the industries into which property casualty insurers are selling their services, their policies, are broadly expected to see improving earnings margin and accelerating sales growth. That is certainly good for insurers. But we end with, and I'll just read the last line here in our note, that with a rising share of most insurers' business priced fairly and economic pressures on loss trends moderating, it seems only natural that pricing pressures would lessen in 2024 and 2025. That's our view. Happy to entertain yours. Just reach out and share it. Thanks so much.